educational series. Today it's on Deciphering Regulation D, exploring its many facets, questions for considerations. Before we kick it off here, I just want to thank a couple of our sponsors here. First, Nuvei, payment rail provider to the world's leading brands, who is now compliantly assisting private companies with their payment rail options, kind of new in the security space. And KoreConX, a little bit closer to home here, all-in-one technology provider for Reg CFs, Reg A's, and Reg D offerings. Now, let's jump into the Reg D side of it. But before I do that, I'd like to introduce our audience to our panel. Nate Dodson, who heads up crowdfunding lawyers and security investment firms. Nate, welcome aboard. Great to see you again. From
Great to be here.
Regulation D Resources, principal founder and president, providing Reg D exempt offering advisory services for the past 20 years. Doug Ruark, great to see you again, Doug.
Thanks, Peter.
And we need the better half on the panel, CEO of CrowdCheck Inc. and managing partner of CrowdCheck Law, Ms. Sara Hanks. Great to see you, Sara.
Thanks.
And last but not least, good colleague of mine, CFO, co-founder of KoreConX and KoreChain, and our own CPA with an extensive experience in public and private companies, Jason Futko. Good to see you again, Jason.
Thank you.
So let's start out with some basics. For those of us who don't necessarily know what Regulation D is all about, and how does it compare with, say, Regulation CF and Reg A. We're going to focus on Reg D today. I'm going to turn it over to you to start with, Sara. What's Reg D? What's it all about?
Okay, so starting point is with securities law always is if you are making an offer of securities, offer or sale, that offer or sale must be registered with the Securities and Exchange Commission under the Securities Act of 1933 or made under an available exemption from registration. And that's what Reg D is. Reg D, like Reg CF, Reg A, is an exemption from registration, and it's moreover a safe harbor. So the way it's structured is if you comply with the rules of Regulation D, then you are deemed to be safely making a private placement that does not need to be registered with the SEC, because the Securities Act says in Section 4A2, if you are making if you make a non-public offering of securities, you don't need to register under the Securities Act. And that's basically what Reg D is. Reg D says if you comply with these sets of rules, you are making a private placement, therefore, as a private placement, doesn't need to be registered with the SEC.
Okay, great. So I'm a private company. I can go out and go get investors, but we know there's lots of rules and guidelines around that. So let's start with, we see various business structures. I hear the terms LLC, LPs, C Corps, partnerships, and there's also a myriad of securities types to consider, So Nate or Doug, you want to jump in to see types of businesses first that are using Reg Ds, and then we'll go into the nitty gritty of the actual rules themselves. Hand it over to Doug or Nate. Jump in, gentlemen.
I'll jump in real quick. Look, as Sara said, really from the legal standpoint, an offer of securities, you're going to want to make sure that you're following the securities rules and regulations, and ultimately, then, there's lots of companies that are using these programs. Software companies, real estate funds, financial services firms. So I think ultimately, when you start looking at hey, we need to go raise capital. The first question is are you going to be executing an offer and sale of securities? And obviously that's where you want to go get proper guidance, because there may be situations where, you would not be in that situation. Obviously plenty of situations where you will be. And so I think that'd be number one is make sure you're getting proper guidance, because first of all, if you are going to be offering and selling securities, there are obviously a lot of options available. Reg D is what I call the more simplistic option. It's the option that I would say has the least amount of compliance overhead associated with it, and typically the least amount of cost associated with it from a preparatory side. But it really kind of spans across almost all industries. And so I think whether you're a software company, whether you're a real estate fund, whether you're going to open a restaurant, when it comes to raising capital, if you're going to be bringing in capital from investors and you're going to have offers and sales of securities, the first thing you're going to want to do is get proper guidance on that. And obviously, to make sure that you're getting into a program that's going to serve your needs well. Again, there are several programs available to issuers, with Reg D being one of them.
Okay.
And,
So,
to jump on your question of, LLCs versus corporations versus partnerships, at the end of the day, it's kind of irrelevant for the purposes of Regulation D. If you're raising capital, you got to pay attention to these rules. Now, that being said, it is always a tax consideration, which I'm sure Jason has a ton of great information to share on that. But at the end of the day, frankly, we do use LLCs a vast majority of time only because of the flexibility from the tax perspective, from the structuring perspective. But at the end of the day, there's good reasons to use limited partnerships or corporations. Very much so driven by Jason over here.
So yeah, Jason, jump in a little bit on tax liability related things.
Sure. Yeah, I'm not really a tax accountant by any means, but obviously whenever you're structuring anything outside of your normal corporate structure, which you probably got advice on right from the start, hopefully, and if you're trying to look at creating a new structure to do the financing, then definitely you want to talk to your tax accountant and make sure you get sound advice on what approach, what jurisdiction to incorporate in. There's a variety of things that you're going to want to discuss with your tax accountant before you go ahead and actually go through with the structure. You can't do that. Like I said, you can't do that without talking to your lawyer. So, it's kind of an all parties discussion when you're getting to this point. And that's why you have to have a good team. So, you've got good people on this call, for instance, all of whom know this field very, very well. And have probably been involved in the structuring side of these transactions as well. So you're going to want to make sure that you're incorporated in the right area, that you get the right advice from both your legal counsel, your auditor, and your broker-dealer, and make sure that you structure a transaction that not only suits your business, but suits the investor needs as well.
You brought up a really good point, suit the investor's needs. Go ahead, Sarah, on that.
Yeah, I was just seeing that one of the questions that was coming through is about whether the company needs to be a C Corp. Just to sort of set the stage here, Reg D is available to anybody who's issuing securities, C Corp, LLC, limited partnership, general, whatever it is, so long as it is a legally created entity, can use Reg D. And also, in contrast to Reg CF and Reg A, doesn't need to be the US. Can be like a German, I've forgotten that. Can be formed under the laws of Germany or Switzerland or wherever. It can be any country, any company from any company, any country from any company, any country. All right.
There's a tongue twister there. So yeah, we want to come back to that a little bit momentarily because you brought something foreign companies doing this, and then this kind of dovetails to my next little question here, which is there's a lot of Reg D, there's different rules. I've got 504, 506Bs, 506Cs, and the attributes or what I can do with those, especially from a foreign and a marketing perspective, can vary. Who wants to jump in on that? Give us the overview on the differences between a 506B, 506C, 504. What does that mean, and what are the ramifications, and how do I decide? Nate, you want to take a stab at that one, or?
Sure, happy to. And in terms of deciding, if you ask me, it always comes down to marketing and where you expect your investors to come from. And just to kind of touch on that, under Regulation D, Rule 506B, you can have up to 35 sophisticated non-accredited investors. Everybody else has to be accredited investors, meaning that they have a net worth of $1 million or more, not including their primary residence, or they're making $200,000 a year the last couple of years, expected in the future, or together with their spousal equivalent, $300,000. So that's one option, but you're not allowed to, they call it generally solicit, basically advertising out in the internet hemisphere or seminars or email blasts. But if you've got your friends and family network, it's a great way, a simple way to raise capital quickly. Comparing that to Regulation D, Rule 506C, there is a, well, good thing. Now you can advertise online, social media, webinars, and everywhere else, but you can only accept verified accredited investors. And there's a whole process behind that as well. Now, with both of those rules, it's much easier to file a notice with the SEC, Blue Sky, just notice filings with the states. You pay some fees, compared to Reg D Rule 504, which people get really confused with this because you can raise up to $10 million under Rule 504, but now all of a sudden you've got to pay attention to all the state laws as well. And so it can end up being a little bit more tricky if you're running an offering that you're raising capital across the United States or in multiple states.
So again, legal advice and get the proper accounting and what are your goals and objectives. So it keeps coming back to the, don't just jump in, do your offering on a napkin, because often it's referred to as, hey, this is a napkin offering. Peter, do you want to invest? Sign here, press hard. And that can fit, by the way, you know, with my friends and family, but certainly not on general solicitation in the case of like a 506.
It also raises interesting points, Peter. And you know, I think Sara brought something up earlier that I think I want to circle back to just quickly because we didn't discuss. I mean, we're discussing the differences between Reg D here, but there are other fundraising mechanisms. There's Reg CF, there's Reg A, and they have different restrictions. So Sara mentioned that, you know, you can use foreign entities to raise capital under Regulation D, whereas necessarily you can't do that under a Regulation CF, for instance. Could we just get a little bit more detail, Sara, from you in terms of, you know, the differences between the three from that major sort of standpoint, as in terms of, you know, if you're trying to structure a transaction as a foreign entity versus as a domestic entity, what does that mean in terms of your options?
Right. Well, I mean, the starting point I will have with the foreign entity or 506B. 504, going back to
we seem to be having a bit of
the fact that
I think we had a bit of a technical glitch. Sara, you might have froze there a little bit. Doug, you want to jump in while we see if we can get Sara back here?
Yeah, well, I think in answering that question, I mean, you know, obviously, as Sara said, Reg Ds can be used by foreign companies. So if a foreign company wanted to come in and execute an offer to sale of securities in the U.S., it certainly can avail itself of the Reg D exemption. With Reg A, it's Canadian and U.S. issuers, and with Reg CF, U.S. issuers. So again, it really comes down to getting that proper guidance. And, you know, I'd like to add too, I just, right now it is a phenomenal time to be able to go raise money as far as the programs go. And look, Nate and Sara have been doing this a long time. They know as well as I know, it wasn't always like this. And I guarantee Nate and Sara had these same kind of calls with clients where, you know, 2008, 2009, you put a Reg D offering in place. It was going to be something like a 504 or a 506B or 505 back in the day when they had 505 available. And the invariable question is, okay, well, I've got this offering and I got offering docs and I got this notice filing in place. I can't go out on my Facebook and let people know about this. You know, I can't go out on my LinkedIn because, you know, those tools were there at that point in time. And I think, you know, that just shows the power of the Jobs Act and how dramatically it changed things, because ultimately these were the program. I mean, Reg D was kind of the primary program that small and medium-sized businesses were most probably going to use to execute security sales. And yet they were limited by these, what I considered to be archaic rules as far as solicitation. And let's be honest, it benefits to have companies raise capital. If they're able to raise capital, they're able to grow. They're able to build their businesses. They're able to hire employees. They're able to pay more taxes on the revenue, right? So I think ultimately, compared to 15 years ago, where we are now is just orders of magnitude better because there are all of these options. And look, if the client's got a pre-syndicated deal and they got 10 people lined up, then they've done business with them before and they just need to bring in some capital from those 10 people. Great, do a 506B. Keep it simple. If they need to generally solicit and they want to raise money from everybody, but they're not ready to step up to a Reg A, oh great, do a Reg CF. As long as you keep it under 5 million. So I think that's the thing that all of us obviously are in the industry. We understand that, but I think for a guy that owns a software company and has never done a securities offering before, they wouldn't know that. And I guess that is the point. Is from a historical standpoint, this is a phenomenal time to execute a raise like this, just because of the options that are there, and then obviously the technology that backstops these raises and makes sure that everything's compliant.
You touched on compliance and maybe think about restrictions, for example. So in a Reg D, and I'll let the legal side of the guys answer this question. So there's a common term called there's a 12-month hold period on a Reg D, correct? So, and each Reg D will have its own legal constraints based on the structure of the contract. So how flexible or difficult is it to say modified down the road? And what does that really mean to say there's a 12-month hold period? Let's dive a little deeper on that. Who wants to weigh in on that? Welcome back, Sara. Glad the connection's good. So 12-month hold, what does that mean? So I'm doing a B or a 506C. Nate?
Sure. I mean, at the end of the day, there's not a secondary market for Regulation D offerings. I mean, we've talked about secondary trading systems popping up for Reg CF, for Regulation A. At least in my opinion, the ongoing filings that happen with the SEC really opens up the opportunity to have a constant flow of information about the offerings. In terms of compliance in general, there's really not major requirements under Regulation D with filings or reporting or financial statements other than what is required at the start of an offering and making sure that proper notice filings actually take place.
So dive a little deeper when we talk about notice filings. I hear I file with FINRA, I file with the SEC, I don't have to file. This is an unreg. When you say a notice filing, can you elaborate on that?
With the SEC, it's called the, Form D. And it is general information about the issuer, how much they're raising, who the management or promoters are, if compensation is getting paid for the placement of the investments. And that, of course, requires broker-dealers to be involved as well. Broker-dealers have their own filings with FINRA, but in terms of the regular issuer that is not placing through a broker-dealer, there's not a FINRA filing. There is the Form D filing with the SEC. And then in almost all states, I think Florida is the only exception, there are notice filings that, at the end of the day, the Form D goes to the states that investors come out of, whether it's 1 or 100 investors out of the state. And every state has their own filing fees.
Hey, Peter, could I just weigh in on an issue with respect to the holding period?
Mm-hmm.
Yeah, because I mean that's something that, and I see one of the questions that's come in from David Ducini there, is it's not a 12-month period during which you cannot resell. The basis for the whole 12-month period is, if you think of it as a you are not able to resell these securities, which are under securities law. These are restricted. And what restricted means is they can't easily be resold. They can only be resold under certain circumstances. And the circumstances in which you can assume that you can resell easily are limited because of the manner in which you acquired the securities. So you bought them in a private placement. And what the US securities laws say is we are going to assume that anybody who buys in a private placement is a distributor, is part of the flow of the securities from the issuer to the public. And therefore, that person's an underwriter. And therefore, to get into the real nitty-gritty here, the exemption that you need to resell, because to go back to what I said at the very beginning, every transaction of securities must either be registered or fit in an available exemption. And people think, oh, well, it's the secondary market. I don't need an exemption. Well, you do. Mrs. Jones, when she is selling her shares on the New York Stock Exchange, is actually, though she doesn't know it, relying on Section 4A1 of the Securities Act, which says you can resell securities if you are not the issuer, underwriter, or dealer. And if you bought in a private transaction, you're kind of treated for that 12 months as if you were an underwriter, that is, somebody involved in distributing the securities to the public. And the reason I wanted to bring this up is because David has raised the issue of during that 12 months, you can find other exemptions. You can sell to other accredited investors. For example, Section 4A7. If you sell, even after the first couple of days, you haven't held the securities for a year yet, you've only just got them, but you can sell them to another accredited investor under 4A7. So I just wanted to flag that issue. And David, thank you for raising it.
Well, you brought something up, or you made a statement to say sell to another accredited investor in the right scenario. So I can't sell it to a non-accredited investor. So that would be a caveat in that regard, correct?
You might be able to, if it wasn't a public, could you sell? If I bought securities, could I sell them to my next door neighbor? Yes, might be able to, if I could fit within the 4A1 exemption. But the thing is, there is a presumption. For those 12 months, there's a presumption that anything you do you're going to be acting as an underwriter, and that presumption is reversed at the end of the 12 months.
And could not your actual the actual agreements which you subscribe to buy those securities, the contractual obligations may prohibit you anyway from that. Is
That's
that
right.
Correct?
That's a really good point. You're making the difference between legal and contractual. Yep, absolutely.
Right. So my contract could say you can't get out of this for 25 years because that's the nature of the agreement. Just because it was a Reg D doesn't give it some inherent rights. It's what's in the contract itself.
Oh, exactly right.
And I'm sure that's something that Nate and Doug discuss with their clients all the time, as far as what's the structure and what are the investors like. Jason, I got a question for you, because we're seeing more companies starting to emulate public companies more and more. And when it comes to transparency, shareholder communication, more companies are getting a myriad of, I've got Reg D investors, Reg CF investors, larger investors that came into my company. Maybe this is a good thing, a bad thing, but by having more improved investor communication, by websites and access to things like cap tables, what are you seeing? Are you seeing more of that? We talk about 35 investors versus 3,500 investors.
Yeah, for sure. And as a transfer agent at KoreConX, we do manage companies with thousands of shareholders. So there is that coming around, and that's kind of a result of the Jobs Act change and changes in the environment. Douglas mentioned it earlier. The last 15 years has been a lot of change, right? You've seen the advance of social media, so there's more outlets to want to post and to look for investors. There's the push of crowdfunding. There's the shift to staying private longer versus going public right away, which has been the typical quick access to capital in the past was you create a shell, or you combine with a shell, or you go public early, and that was one of your other accesses to capital once you exhausted your friends and family and maybe your broker dealer network of investors. That change has also been rippled through with other effects like the responsibility, social responsibility, transparency that investors are pushing for. They put those demands on companies, and they're requiring more access to information. So that's why you see companies starting to act a little bit more like a quasi-public company in that sense. They want to be able to provide the information that these new types of investors under Reg CF or Regulation A, for instance, are pushing for. Empowering investors to log in through a portal that gives them access to manage their portfolio, access press releases, reports, communicate with the company, even do e-voting in some cases on their AGM is very important to a lot of them. And of course, this is all linked to governance tools that help the company manage things like their cap table. You're seeing lots of cap table management type things right now. It used to be done on an Excel spreadsheet, but no more. People want to expand that functionality and be able to offer different services that are beneficial to not just the company, but to the investors that are investing in the company, and provide them ease of connectivity.
Got a question that just kind of dovetails right off that, and that's specifically from Robin here. I'm just looking up, and it's saying, so who manages the cap table and tax filings for K1 for a 506C if you get a large number of investors, because you can advertise? And that can happen. You can get a larger number of investors. Remind me to ask, how many investors can I have on a Reg D 506C? But as far as who manages the cap table and tax filings, how does that work? Jason, maybe you've got some.
Yeah, sure. I mean, typically, Reg D doesn't require a transfer agent, but there's no reason why you couldn't utilize a transfer agent to help you manage this, particularly if you are raising from a 506C where you've got multiple shareholders versus a friends and family round or a small 506B offering. If you're going to have a lot of investors, it might be worthwhile to go out and spend the extra dollars to pay for a transfer agent to help you manage your cap table, manage that investor information, take care of K1s or other reporting requirements or things like that.
So it sounds like it keeps you organized, facilitates a large number of investors, facilitates things like K1s, facilitates the ability for reporting. So, okay.
Well, Peter, to add to that real quick, there's a real educational aspect to, I think, the technology that backstops these offerings now. And it's interesting because I'll run into people where, the last time they did an offering was, 2007, maybe they're a real estate syndicator or what have you. And a lot of times they come into this process with that old school mentality of, hey, I just want a handful of people at 500,000 apiece. And the mentality really for them is that they don't really want to have to manage a lot of investors, but they're also coming at it from a knowledge base of 15, 20-year-old technology that, so I think that's the other thing is when people start demoing, like KoreConX's system, and they see how seamless it is to manage a larger cap table now, and they start understanding, well, hey, these people are my affinity base. So if I do a first round for a real estate fund and I end up with 3,000 or 4,000 shareholders, and then I go do round 2 out of that same fund, as long as those people are getting what they expect and they have a good relationship with the fund, that's your affinity base. I mean, they're going to be there to support the fund. They're probably going to put more money in. I mean, let's think of it this way. I might put 5 or 10 grand in just to kind of see how everything goes. And if a year or 2 in, I'm getting a great return and you're launching another round for that fund, now I might put 25 or 50 grand in because you've proven yourself to me. But I think, that we're all in the industry, so we all kind of understand the technology and the capabilities of where we are now in 2023. But, the average entrepreneur out there doesn't. And I think that's the benefit of these types of, obviously, these types of educational things is the fact that technology is phenomenal now. There's nothing to be afraid of having a bunch of people on your cap table because the technology to manage them is so good.
Well, hey, it makes it easier, but there's always things to be afraid of with technology. But that comes from change, and I think one of the biggest things that we experience is change. So, back to the Reg D, how many shareholders in a 506c can I have?
Shall I take that? It's not so many how many in a 506c can you have, but once you get a whole bunch of shareholders, are you running into a problem? And I think what you're referring to here is Section 12G of the Securities Act, the Exchange Act 1934, which says if you have assets of $10 million and a class of shares or class of securities that have more than 2,000 shareholders or holders, no more than 500 holders who are non-accredited investors, then you need to register and become a fully reporting company with the SEC, which, as we know, can get very, very expensive very fast. And so one of the things that companies have done is when they're selling to a bunch of accredited investors under, say, 506c, is fold those into a special purpose vehicle, which they hope, at least for the moment, counts as one holder. And the reason I'm saying for the moment is there have been continuous references to the fact that the SEC may be looking at the definition of holder of record in these circumstances, because what companies have been doing for a long, long time, and they've done it for decades, is they're trying to use any kind of structure they can to avoid having to become a fully reporting public company. And so so at the moment, providing that the SPV was not created purely for the purposes of evading Section 12G, which we know some of them are, then that SPV counts as one holder. Is that going to continue? We don't know, and they could be changing this. So, the bottom line, and to fold this into the online capital formation world in general, is companies with their transfer agent should be constantly keeping an eye on how many shareholders they have and which holders they might be able to count or not count for the purposes of the 2,000 or the 500 count, because under Reg CF and Reg A, which we're not talking about at the moment, there are conditional exemptions that say under certain circumstances you don't count these. But the thing is, you're going to have a good transfer agent keeping track of how many shareholders and who falls into which bucket at any given time.
I got to say, you just encapsulated my entire next question when it says, how do we trigger various reporting requirements when I'm using multiple regulations, for example? I guess the key to all of this is you need to have good record keeping, right? And you need to understand those different classes of shares. A topic that's come up recently, and it was, and I think maybe it might have been even one of your blogs, Sarah, was if I'm doing a Reg D and I'm doing a Reg A, for example, and I have the same share structure, the same class of shares, does this kind of jump into what you're talking about as far as the number of shareholders, to say the guidelines on my Reg A versus my Reg D are a little bit different, but I'm lumping them together?
Well, you don't want to lump them together. I mean, you want to make sure that you are keeping track of who obtained which securities under which circumstances, and continue to track, because the Reg A status, the conditional exemption, stays with the securities, not with the holders. So if I buy under Reg A and then I sell to you, Peter, then it's still a Reg A security as far as the SEC is concerned, and so has that same status as, so long as you fall within the conditional exemption, you don't count the Reg A holders. But you do not want to lump them together unless the SEC forces you to lump them together and count them.
So I know, for example, Nate, you've done lots of work with multiple regulations at the time. I know we're focusing on the Reg D, and the beautiful thing of a Reg D, I can raise any unlimited amount of capital. So that makes sense. And Doug, you've talked about that on panels, if I recall. And you combine it with another exemption. I can take advantage of exemption, say Reg A, do a Reg D as a beside it, or a CF as a sidecar. What are the things that you're advising your clients to say when you're doing that? Some of those consideration pros and cons.
Well, I personally, I love running a Reg D 506C side by side with the regulation CF. So, really, it's now all of a sudden you can generally solicit and advertise, but still accept up to $5 million of non-accredited money. Now, one of the pros of it is, of course, now you can bring in the non-accredited investors into the same deal, which has been really unavailable other than a non-advertised Rule 506B offering. But at the end of the day, it's also for a lot of the deals, and we do a lot of real estate syndications that have to go beyond $5 million. And by leveraging the multiple exemptions, it is a way to be able to get beyond the 5 million. One of the negatives or positives, depending on the way you look at it, is really I focus on structuring the Reg D where it's incentivizing the accredited, the larger investments with the regulation CF, which tends to have lower minimum investments. And you don't want to just bring in a bunch of accredited investors that are all investing $5,000, $10,000 at a time. You still want to be able to incentivize them to write the larger check. And I think having two offerings, the CF hand in hand with the 506C, really opens up some amazing opportunities to make it take place. There are some advertising limitations in terms of now all of a sudden the 506C needs to make sure that it's also abiding by the regulation CF advertising restrictions that are under FINRA, because with regulation CF, it has to be under a FINRA registered crowdfunding portal. So there are some finite details and changes, but I'm a huge fan of running both simultaneously.
Okay, good. Or just a slight correction. So a crowdfunding portal on a CF, or if you have a broker dealer who controls a single page, it's not what somebody might think is a traditional crowdfunding portal with multiple offerings. You can do a direct issuance with a CF and also do a Reg D on a separate sidecar with your Reg CF and I guess achieve what you're trying to say, or what you so poignantly said. So, Doug, from your experience, when it comes to incentivizing in a Reg D, if I'm going to do a CF and a Reg D, because I know you've been involved in both of those as well, what are you seeing? Is it a dollar amount? Is it warrants? What's been your experience in some of those offerings?
Well, I mean, a lot of it depends on the client and the company, because I've actually seen some pretty interesting kind of perks. For example, you might have a client that's got a VRBO real estate fund, and for the higher net worth crowd that's going to invest, if they invest over a certain amount, they might get like a week, free at one of the vacation rentals. So a lot of it really comes down to the client. What are their needs? What are they trying to accomplish? Totally agree with Nate, though. I mean, like at the end of the day, that CF is there really to accommodate those smaller non-accrediteds, and you don't want to be packing the accrediteds in there. Ultimately, then that's where that works great to have that Reg D working alongside it. So it really depends on the deal. I mean, it could be something like warrants or options. It could be a separate class of security, for example. And it could be something where it's like a non-monetary perk. It could be something where they're getting a vacation rental, or they're getting product or something like that. So yeah, it really depends on the client and the company, and what they're looking to accomplish. And, sometimes they may just not even have an incentive on it, but I do think ultimately, You want to try and kind of drive the traffic there, as kind of Nate was talking about. So typically you would see some type of incentive to get those accrediteds in at that higher amount through the Reg D.
Okay. So the incentives and the general marketing, Nate, you mentioned general solicitation. We know that on a 506C, we can do general solicitation, but you also said if I'm doing a CF beside it, there's certain guidelines and restrictions what I can say and how I can market with my CF. Is there a difference if I'm just running a D or if I'm running a D with the CF on what I'm saying between the two, even though I might be having two slightly different offerings as far as the terms go? Does having that CF put certain requirements on my Reg D marketing?
Yes, primarily with the FINRA oversight in terms of claims on any returns. There's some pretty strict oversight and restrictions on the FINRA side there, where if you do go to a lot of the online portals, looking at the Facebook ads as an example, there are generally some claims or future forward-looking statements of what are expected to happen, that really there's a lot of limitations on FINRA oversight.
Okay. So talk to your broker dealer, talk to your lawyer, make sure that you're delivering the message appropriately. The beautiful thing is that you can do general solicitation. I think on a past panel, we talked about how wide a net do you want to cast? Often investors or issuers will say, hey, I want to do credit investors, only want big tickets. And my first response often is, how many do you have? And if you have them in your back pocket, you got 10 guys, you don't have to do any of this. Take those investors, do your Reg D, it's fast and easy. The reality, though, is you have a wide net if you're potentially using multiple exemptions. Doug, Nate, Sarah, do you know how many accredited investors are out there, do you think? Percentage of the market? I've heard 10%?
Yeah, this is something I always push back on, because people keep saying, like 97% of the public can't invest. When you look at the triennial Federal Reserve study, when they break out how many people are there and what have they got, and what are their assets. And that's the guidelines that the SEC uses. It's somewhere around 12% are accredited. Now, that gives you a huge chunk of people. However, a lot of those people are, it's grandma. Grandma and grandpa are in their 70s and they've done well, and they've got nice little 401ks, which counts as assets, and they've got the river house, which, not being their primary residence, counts as an asset. So you need to pull that out before you get the people who are actually investing, because grandma and grandpa, or at least my grandma and grandpa, are not investing in general in Reg D. When you look at the numbers kept by people like the University of New Hampshire, you're getting closer to maybe there's like 500,000 people who are investing on a regular basis. So you've got this wide variation of like millions and millions who are eligible and very few who actually do.
I think you nailed it. So my bucket or my opportunity gets smaller and smaller. Who's going to invest? And you say I've got an aging population, so there's different audiences that might not be accredited today. So that, Nate, to your comment, and Doug, your comment of using multiple regulations to have a wider net of investors and potentially brand advocates that are going to grow with the company makes really good sense. Yes,
well, Peter, like you said too, a lot of it is who are you going out to? I mean, because if you've got a med tech company and they just need to maybe raise $5 or $10 million, and they've got a deep affinity base of doctors and surgeons and people like that they're going to go to, they may just go with something like a Reg D 506C, because the chances are the people they're going to be raising money from are going to be accredited. They're probably not going to need the capabilities of a CF. They get to bypass paying the commissions out to the broker dealer. It kind of drives back to what I said earlier. The nice thing about where we are right now in the industry is there's probably going to be a fit for what the client's looking for as far as what their needs are. And there are clients out there where they're pretty confident they'll raise money from the accredited crowd. And in that case, then go ahead and keep it simple. Do a Reg D 506C, or if it's a pre-syndicated deal with, established relationships, do a B offering. And like I said, it's nice just because it wasn't always like that. You didn't always have all these options that were available.
But I think everybody needs to be intellectually honest when we talk about, look, we all fall in love with our own business. We fall in love with our own offering. We put our heart into it. We're passionate about it, whatever that might be. But when the time comes to say, I'm going to go raise $5 million from all my buddies that might be doctors or my wealthy friends, suddenly the minute you have that conversation, they're not all just jumping to throw their money in. They're going, you know what, I got kids in college. Timing isn't quite right. So there's a reality check. So at the end of the day, anybody raising capital you better have as wide a net as possible, because it takes work. And I don't think anybody here would disagree with that.
And if I could hop in there just real quick, because something that we definitely train a lot of our clients on is you can switch different exemptions. So you may have that friends and family round under the 506B, but now you've gotten to the edge of your network. You don't have enough cash. There are the opportunities to change to a 506C and continue to now market and advertise and cast that larger net out there. So you're not just stuck with, this is the plan moving forward, and if I don't hit my target, I'm dead in the water. There are options.
And I just love what you just said there, because many a company is used to, and I think somebody said earlier in the conversation of, hey, 12 years ago, Doug, you said people were saying this is how it's done. I don't want lots of investors. So I think you got to take a hard look at, there's multiple regulations, and the friction points that were historically there for managing people, it's getting easier. It's as simple as that. And the ability to take advantage of general solicitation is there, but then that dovetails back into, let's say, compliancy. Yesterday's panel talked a lot about both companies and broker dealers holding themselves to higher standards, specific to due diligence, even on accredited investors. I want your guys' viewpoint on that, because in the panel to weigh on, what are the responsibilities, specifically we're focusing on Reg D, for KYC, ID, verification, anti-money laundering verification, especially since now you're doing general solicitation. A little different than the B. I know the guy's really well, friends and family. I told you I'm worth $1 million, but maybe I'm not the best guy. Somebody want to weigh in on that? And associated liabilities.
Well, I think you need to divide the whole due diligence AML into sort of several pieces, which is, if you're a broker, then you have you have KYC obligations. If you're a broker, you've got to know the client. You've also got FINRA obligations to do the due diligence that the company is actually selling what it's selling under FINRA 1022, which is one of the FINRA pronouncements. If you're not the broker, then you still actually have not KYC obligations, but anti-money laundering obligations. None of us, the ice cream store, the broker-dealer, Goldman Sachs, whoever, none of us can do business with anybody from Iran or North Korea. And we should all actually be checking all of the people that we take money from, our clients, not just the clients, but the lawyers. We should be running AML against anybody that we are doing business with to make sure they're not on any of the sanctions lists. And we've seen, hotels be prosecuted on AML failures because they let North Korean or Iranian check into the hotel. That's an actual example.
So they might, I think most businesses and companies, they have good intentions and they have good faith and good belief, but if they're not looking at the liabilities associated with not doing certain, like you say, anti-money laundering checks or ID verification, what are some of the repercussions, or maybe just some anecdotal stories you guys may have heard? This isn't to scare everybody to say, but it's to say, you got to hold yourself to a higher standard and check things. Nate, Doug, have you heard much out there? Sarah?
Well, I would definitely like to add just a little bit more to kind of the issuer's responsibilities, because at the end of the day, there's always some suitability obligations that goes kind of hand in hand with the KYC, but under the Reg D 506C, you've got to have the verified accredited investors, whether or not the issuers are doing it or they're getting the written professional opinion from a CPA. There is some suitability and requirement with that verification process. But then also on the Reg D 506B side, if somebody is non-accredited, it's sophisticated non-accredited investors. So getting that background information, not only just, but it's also so important to verify that they are who they say they are, but based on the information provided and signed off by the investor, are they sophisticated enough to understand the risks of the investment itself?
So investor suitability, you touched on attestation. I need to prove that I'm an accredited investor. For those in the audience, the unique thing about a Reg A and a Reg CF versus a Reg D 506C is it's self-accreditation. I tell you I make $200,000 and I can invest up to the certain regulatory thresholds in that exemption. But on a Reg D 506C, I tell you I make X amount of money. I'm supposed to prove it to you with either, like you say, a letter from my lawyer, accountant, financial statements. Again, I think there's 9 attestations. If I don't do that, let's be honest. I've known Jason for a long time. He's an accredited guy. But I never got his documentation. If Jason came back later and said, I'm not accredited, Peter, and you never got an attestation, could I be in trouble? I know this isn't quite your legal, but I could be in trouble, right? You might have to give him his money back. Would that be a fair statement?
It's possible if you didn't take reasonable steps to verify. And that's the issue. It's reasonableness. So if Jason, you know that Jason lives in a van under a bridge somewhere, and he says that he's accredited, that might not be so reasonable. But if you live in Beverly Hills and Jason lives next door and he turns up every day in a chauffeur-driven Rolls Royce, that might be a reasonable thing to assume. So it's always going to be facts and circumstances in those cases.
Suitability might be good, anti-money laundering might not be good. So I need to make sure I'm doing all my verifications, I guess, right? You just touched on something here that's a little closer to my house here, and it comes to, we're doing things online from a tech investor application process. This one drives me crazy on Reg Ds. So I get 2 issuers. Issuer A says, I've been doing these for a long, long time. I want it to be seamless, fast, and easy for my investors to come in. I'll deal with the attestations later. I go, okay, technology can do that really easy. Say, answer a few questions, and we'll take your investment. But then the onus is on that issuer, or if they use a broker-dealer, to get that attestation. Now, but on the flip side, technology-wise, we get somebody says, I want them to go through every bit of documentation online with all these friction points because I want it to be done in a single transaction with that investor. Some investors go, I like that process. Other investors will not. And then you got you folks involved. I'm used to doing it this way. This is how I do my forms. This is how I do my documents. So I'm talking about like short form, long form, concierge approach. Somebody's filling in the paperwork online on your behalf. We look at it as the future of compliance will be, I better be tracking everybody. Who touched it? Who filled in the document? Who signed it on somebody else's behalf? Where do you guys see this today? And what's been your experience? I mean, you guys have done, Doug, you've done Reg Ds for 20 years. And now you're bringing it online, but there's got to be some change issues that are challenging.
Well, look, I think that's why using technology is so helpful, because ultimately, if you had a spot audit from a state regulator, right? State regulator sees you filed a Form D and they decide to show up and check your records on your offering. If you're using technology to manage these processes and, for example, properly date stamp and archive a verification, it's going to make it a lot easier. So I think ultimately that's why you're seeing so many people these days when they execute, they're going to execute using some type of technology. I would also say that when you start looking at CFs and Reg As, one of the benefits is you do get a clean 3-minute investment process. Anybody that's obviously demoed, Kore's end-to-end subscription processing knows that, right? So I think that's the other thing is that, as you said, you do have a more frictionless investment process there. And then, I'll add that, ultimately, you certainly could bring a broker dealer on board that is an admin type BD on a Reg D. You certainly could bring a transfer agent on board. Obviously, you could certainly have third party escrow. Those things are required in a CF. And I think ultimately I call it the trifecta of trust, in that investor goes to a CF raise portal, and that broker dealer, transfer agent, escrow, it's all prominently featured there. And not only does that make the investor feel a little bit more comfortable, but it's going to make the issuer feel more comfortable, because they have a team there supporting them on the compliance and on the tracking. And then again, using the latest technology available to make sure that they are managing these things with best practices.
Well, thanks for that. It makes us in the tech world think we're doing something right too. But it also says things are changing and evolving. Nate, what's your experience or transformation going on? Are you doing? I mean, look, we used to see. I've got old stock certificates sitting in a filing cabinet from somewhere, in the medallion world, and I wonder where the company is, where things are now digital online. But as far as the preparing, and the paperwork, are you seeing more companies doing direct offerings and Reg D, like online, 506Cs, fill it online versus send me the paperwork and let me get, sign 24 pieces of paper?
I gotta say, the vast majority of the issuers that I work with, whether they're serial syndicators and they do deal after deal after deal, or with a company raise, even if it's just a Reg D, technology has made everything so much more simple, seamless. I don't think a lot of people want to create the hurdles, the friction. If it takes a couple extra steps to get that professional opinion from the lawyer, broker dealer, CPA later for the attestation, to allow the investor to sign everything, fill everything out, review everything, check the right boxes, all online, has made the process just night and day simpler. And I believe at least that most issuers are hearing that loud and clear. And it's definitely the trend that's been happening and will continue to happen into the future.
As from a legal perspective, are you lawyers modifying or being, I guess you have to be, more open? Like, I've seen documents that have come across my desk that said, okay, we need you to digitize this, but I want to check boxes and circle things where it just makes it impractical from a tech perspective. Are you guys now saying, hey, let's structure our offering documents in such a way for signatures that are easier for technology? Sounds like both you guys are. You have to
take that into account.
So it's okay for tech guys to push the lawyers and say, structure it this way, or you can't go online?
I'll say the biggest risk is the tech guy saying, okay, well, we are just going to ignore those documents and use these other ones that haven't been reviewed. And I've seen it happen multiple times. It's a risk that's out there. So for the lawyers to be able to and have experience working with the tech side of things, I think is unbelievably important.
Then that's perfect. I love how you said that. Both parties have to communicate, and you can't give an inch. If tech wants to do it this way and you want to do it that way, there has to be a meeting in the middle so that everything's compliant, so that all the information is on those documents that you're referencing. So, okay. I got a note here that Rule 144A, facilitation of resale. It keeps coming back when people are saying, oh, I can tokenize my real estate and I've done it on a Reg D 506C, and Rule 144 lets me, provides liquidity to institutional. It just sounds to me like a lot of, but who's doing it and who's transacting, and maybe Sarah, you can weigh in on what that all means.
Yeah, I'd like to make the distinction actually between Rule 144A, capital A, and Rule 144, because Rule 144A, which I wrote when I was at the SEC, is for big, like, qualified institutional buyers, $100 million assets, not really the rest of the world. And that, to go back to what I said earlier, there is... when you're buying restricted securities, there is an assumption, at least for a set period of time, that if you were to resell, unless you were to do so in specific circumstances, you'd be an underwriter and you'd need to register that offering. Rule 144 says if you comply with these rules, you are not an underwriter. And so this is what most Reg D investors come up against, is at the end of a 12-month, or in some cases 6-month, if it's a registered company, at the end of a period, then those guys can resell really easily. But in most cases, the transfer agent is going to be wanting a letter from counsel that says you really can rely on Rule 144. And that that is fairly easy to do, because so long as the holder is not an affiliate of the issuer, there's not really much they have to do apart from just hold the securities for a specified period of time. That means they can resell legally. Does it provide liquidity? No.
No.
If there isn't a market there, you can resell if you can find somewhere to resell, is the thing. But at least you can take the legend off, to go back to the transfer agent discussion. The little legend that says these are restricted securities, that can come off. And then if you can find a place to resell them, then you can resell them.
So again, know the rules, know the regs, and read the specific clauses in that particular contract that may say you got to hold on to this for 12 years, Peter Daneyko, I've been there, and you're not going to get out. So we're winding up to the top of the hour. 2024 is approaching us. Rumors, whispers, what's changing? We're seeing more and more companies using all of these exemptions. We're seeing general solicitation. Are we going to see more suitability requirements, more regulations coming into play to protect the investors? Any predictions, any thoughts, or any rumors that you guys have heard?
I'll just add a general comment. If I was running the SEC, I would probably rather see issuers going into Reg CF or Reg A plus, because of the we'll call it compliance backstop that's there. I mean, the broker dealers, transfer agents. I know the broker dealer's not required in a Reg A, but obviously a Reg A's SEC qualified offering. So, if you're the SEC and you're looking to maybe have a little bit more control over what issuers are doing, then it would make sense to maybe incentivize issuers going into some of these programs. And, how do you incentivize them? One of the ways is obviously taking the limits higher. I mean, obviously they did that several times already, obviously with CF from $1 million to $5 million. They did it with Reg A. There's proposals to do it again. I think ultimately it'd be interesting to see them take those limits up. I mean, there's certainly clients that could do a CF, but ideally they need to raise $7, $10, $15 million. So I don't know. I think it'd be interesting to see where they end up with that. But again, I think with the technology that's there and with the way these rules have been set up, if you're the SEC, in my opinion, you kind of would rather see people go into the CFs or Reg A's, because there's a little bit more in the way of a backstop there from a compliance standpoint. With the CF, you're required to have an intermediary, and obviously with the Reg A, it's an SEC qualified offering, so they're getting a chance to review unqualified.
Yeah.
And again, to Nate's point, sorry, pure volume on a Reg D, I can raise unlimited amounts, and working in conjunction with multiple exemptions. Sarah, you've got something to...
Yeah, I would be absolutely amazed if either CF or A change in the next 12 to 18 months. Where I do think we might see a change is, when you look at the SEC's rulemaking agenda, we've seen Reg D at the top of that for 2 years now. And I think there is a possibility that we'll see the eligibility requirements raised. I think we'll see Form D expanded, and I think they might do something with 12G, as we talked about before. But if it is going to go through, we're going to have to see a proposal in the next couple of months. Otherwise, they're not going to get done before there is a potential political change next November.
I think there's been a huge rumor mill about them increasing the requirements or the rules surrounding the accredited investors. Personally, I don't think it will happen anytime soon, but it's definitely been the rumors. But it just lends more credence to exactly what Doug was saying, pushing more issuers towards the Reg A, towards the Reg CF. But I still see it as just a benefit and boom for the capital industry of being able to run still the Reg Ds, even with even a smaller pool than 500,000 going to Sarah's credit in her numbers, but being able to do really the CFs, the A's in conjunction with the 506Cs, I think will continue to create amazing opportunities.
Well, panel, we're at the bottom of the hour. I thank you very, very much. And I learned something every day. I got to remember, don't add an A to a 144. You dramatically shift what that meaning is. Liquidity for institutional versus liquidity for the accredited investor. That's my little personal note. Again, I thank you all, panel. And until the next KoreSummit, hopefully it's become educational to all our participants.
Thanks
Have
again.
a great afternoon, everybody.
Thank you.